perhaps I'll just show gold in the context of the markets in general. Here we have the period before the collapse. Where my mouse is here, you can see I'll just run through the top line, the orange line. That's the gold price, and I'm putting my mouse where this collapse started to happen. And you can see gold did dip a little bit. But over the last month, it's down. Well, it says right now as we speak, it's up 1.86%.
It's holding up like a rock, and well,
exactly.
Friday, August 9th, 2024, Monaco 64, home of alternative economics and contrarian views. Good morning, Clive.
Good morning, Mario. The sunflower you see behind me is just wobbling in the air conditioning. It's not agreeing or disagreeing with me.
Okay, so many of you might think we're a little late today, and we might be, but it doesn't really matter. It's around 9 o'clock London. We usually start a little earlier, but you've got the whole weekend ahead to watch this. But what are we going to talk about today, Clive? I'll let you kick off with what you've got in mind, and then I'll chime in.
Well, I think it's been quite an amazing week. If we start off on Monday with the Japanese stock market collapsing, and I honestly thought when I saw this happening in the middle of the night on Monday morning, I thought, my God, this is a major collapse, because the market was down about 13% on the day. And I thought they're bound to cut interest rates in the United States because we're going to have a collapse in the US stock market. And we all know that there's what's called the Fed put. It's not the official mandate of the Federal Reserve. The Federal Reserve official mandate is to maintain price stability, which they call 2% inflation, and to keep the labor market below a certain percentage, keep people in jobs. But unofficially, we have what's called the Fed put. And we've seen this countless times in the past, that when the stock markets have collapsed, the Fed has stepped in with an emergency meeting and lowered interest rates. So I was pretty convinced by early Monday morning that they were going to cut the interest rates in the United States to stabilize the markets. But they didn't do that, and markets quite miraculously stabilized. And I think what I can do here is talk through, if you let me share my screen, Mario, I can talk through what happened day by day, even minute by minute on the market, so we can see how that played out. Can I bring up a screen here? I'll just bring that up. So it's here and share. So what I hope you're looking at now, I hope you can see this. It's the on the white line on the grey background is the Nikkei at 225 index. It's actually the futures index, because that trades almost 24 hours a day. It's not the actual index, which only trades during opening hours of Japan. And if you can see, the market was relatively steady in the days preceding the line, the vertical line, the red line. That's the changeover from the weekend, from Friday through to Monday. And you can see on Thursday, which is between the two big lines here, and then Friday, the market was falling. And then we opened up on Monday morning with an absolute collapse in the market. That's after several days of big falls, which was down. Those 2 days were down about 15%, Thursday and Friday. We now have a large fall, and that's actually at one point in the day on the futures 13% down. And that meant that the Japanese stock market was technically in a bear market, because a bear market is when stock markets are down 20%. So what I thought would probably happen early Monday morning, we see where my mouse is. I thought that there were about 13% down there. I thought that the US stock market would open up a lot lower, and then the Federal Reserve, probably the next day or the day after, would be forced to step in and lower interest rates. And I was betting that we might have an emergency cut of 0.5%. But what you can see on the index, the white line going up towards the close of the day, it recovered sharply towards the end of the day. Now, where my mouse is now, where it's recovered almost, not all, but a lot of the fall, it's still down about 6% at that point on the day. That's midnight, effectively, when the futures stopped trading.
Yeah.
and we've continued to recover since then. So what I thought we'd just do is just look at how the US stock market behaved over the same period. And the red line is the Friday night, Monday morning. And you can see the US stock market did initially plunge, which is kind of what I expected. It's the green line going down here, and then recovered. And why was this happening? Well, we're going to look at the Japanese interest rates here, which I've just brought up. You can see on this chart 3 lines. The red line is the 10-year bond rate, which you can see back, we're going back now, right back to 2010 on the chart, or even 2009 on the chart. But you can see by about 2016, the yields on the 10-year were negative. And broadly speaking, they stayed until 2022, where my mouse is here, yields were on the 10-year negative to flat. They were 0% effectively. And then from 2020, early 2022, they start to rise. And you can see they've risen to about 1.1%. It's slightly below that now, but we'll come back to that in a second. Meanwhile, if you look at the blue line, which is that's the official rate of the Bank of Japan, BOJ rate, the discount rate, if you like, was negative minus 0.1% for a very long time. I'm running my mouse along. If you can't see the line, it's running my mouse along there. It's minus 0.1. And then suddenly, in May, they raised it to negative, from negative 0.1 to 0.1. So that's a rare, going from negative 0.1 to positive 0.1. And then in the last few days, which is what caused the collapse of the stock market, they raised it to 0.25%.
Yeah.
The black line, which you see above, is the interbank rate. That's what one bank will lend to another. It's obviously above the official rate. And you can see that at the moment is trading at 0.45%.
Yeah. So can I just say one thing, Clive? When you showed the Nikkei and the I don't know if it was S&P or NASDAQ, the US stock market, beginning of the week. The other thing I noticed is that on Monday, the NASDAQ, for example, was down like over 1,000 points before the regular hour opened in New York. And I think what happened and why we didn't have some emergency cut is that the not just the Fed, but also what's called the Working Group on Financial Markets. It's colloquially known as the PPT. And it's the Fed, the SEC, the Treasury, and who else? The CFTC, who regulate the futures. I'm sure they're very busy on Monday morning before the U.S. market opened, and they probably even told some of the brokers freeze the online trading so people can come in and sell everything all at once. Some people say, oh, it's because of the traffic, you're being too conspiratorial. And then I think also on Tuesday, the deputy governor of the Bank of Japan came out and said, well, we will only raise rates if the stock market is stable, which is really weird because the stock market became unstable because they raised the rate from 0.1 to 0.25, and it just goes to show how leveraged this thing is. Just wanted to point that out.
Well, the other thing which happened, if I now move to the much shorter term, if you look at the red line, which is the 10-year bond, you'll see that, I just bring it up 1 month now. You can see this is the yield on the 10-year bond. And as we part, where my mouse is here, that's when the crisis was happening in the stock market. The yield plunges. What does that mean? It means the Bank of Japan has stepped in and started buying government bonds. They're buying the 10-year bond to lower the yield on the bond to stabilize the stock market. So I think we don't know that for sure because we don't have any official confirmation of it, but I'm pretty sure that the sudden drop in 10-year yields, it could have been Japanese investors selling stocks and buying the treasury, but I think there was probably what's been going on for years and years and years in Japan, so we know they've been doing it for years, is yield curve control. I think they stepped in and did a bit of yield curve control, lowering the interest rates to make the stock market look a bit more attractive. a lot of your, not a lot, a small number of people wrote to me last week and said, Clive, you've been talking about gold, and you said gold is a hedge against these sort of things. What's going on? Gold is down. So I'd just like to bring up a chart here of where gold is today. This is a chart going back to 2016, and you can see gold is almost at an all-time peak. So it's been a kind of hedge. And perhaps I'll just show gold in the context of the markets in general. Here we have the period before the collapse. Where my mouse is here, you can see I'll just run through the top line, the orange line. That's the gold price, and I'm putting my mouse where this collapse started to happen. And you can see gold did dip a little bit, but over the last month, it's down. Well, it says right now as we speak, it's up 1.86%.
It's holding up like a rock, and well,
exactly. The line below it is the S&P 500, which over the last month is down 4%. And you can see clearly it was much more volatile than the gold price. And that's the green line. And the line below that, which is the black line, that's the, just out of curiosity, the yield on the 10-year Treasury, US Treasury, which obviously was falling as we went into the price. It's now recovered a bit because the stock market's recovered. And we've also got the line on the yen here. I'll just look at the yen specifically, because I think that was quite interesting.
Sorry, Clive, what's the green line?
I'll go back there. So the green line, that was that one. This green line is the S&P 500, the one at the bottom.
One. Yeah.
That's the 10-year yield. So
okay.
You see, as the crisis starts about here, the yield on the 10-year goes down, 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 down. At one point, the yield is 30-odd% below where it was, and it's recovered a little bit. So if I bring this and make this a much shorter period, 5 days, which is basically since the crisis started, we can see that the gold. Just make that. I'm going to bring that back to go back to Friday. There we go. So that's why I'm going the wrong way here. Go back to Friday. There we are. So the gold price since Friday, since things started collapsing, is up 0.4%. The S&P is down 2.37%. The yen is currently down 3.84%. I mean, when I say down, actually that means up. It means the exchange rate has gone from 161 to 140 something. So it's actually up technically. The yield on the 10 years down about 4%. The Japanese stock market is still down since Friday, about 8.5%. And so what we've got is everything is down, but gold has held up very nicely compared with all the other things you could have held. So it's been a great diversifier. Those who held some gold in their portfolio had less volatility in their portfolio than those who had no gold at all.
That's right.
I'll stop sharing here, Mary, unless you've got some other questions on that.
No, that's fine. And it's interesting because before we started recording, we asked each other, what do you want to talk about? And one of the things I wanted to talk about was the fact that, and I hadn't heard what you're gonna do now with those charts at all. I didn't know you had those charts. And I told you that I think I showed you, I think, this chart here of gold, where I told you about it, that the quarterly chart of gold going back to the 70s looks really bullish. And it's amazing because there's no euphoria or anything about gold. Maybe it's because silver has been lagging a little bit behind, and we can talk about silver in a minute. So yeah, I think it's amazing that this chart looks so bullish. And of course, it's a quarterly chart. It takes away all the daily noise. So that seems to kind of confirm what you're saying, that gold is becoming a lot more. It's becoming, well, it should always be the most stable store of value, so it's not surprising that it's acting as it is.
So, I mean, I think another surprising thing about the gold price is it's been rising despite the absence of Chinese buying. Um, the Chinese have got about 72 million ounces of gold compared with America's 251 million ounces. So the Chinese have got a long, long way to go before they get close to anything like America's gold. So you'd have thought they would still be buying, but they haven't bought any in May, they haven't bought any in June, and they didn't buy any in July. Yet the gold price continues to rise. Now, from the Chinese perspective, it does mean that their officially reported gold reserves are showing record numbers. They're at a record level in dollar terms, but in terms of ounces, they're holding the same number of ounces as they held back in April. And I think what's going on with the Chinese is they've decided to stand back from the market due to the rising gold price because they don't want to throw petrol on the fire. Because they'd like to buy this gold as cheap as they possibly can. And they're kind of hoping that the gold price will stabilize to allow them the opportunity to acquire more gold at a lower price, or at least at the same price at the moment. Surprisingly, the Chinese reserves overall went up by about 41 billion in the month. That's a very large rise. So that would include dollar reserves and reserves of other currencies. But the gold reserves did rise, but obviously only in dollar terms, but not in terms of number of ounces. But I think one of the things which might be driving gold at the moment is some of the factors which are normal drivers of gold. One, we do see the probability, the expectation that the Federal Reserve will lower interest rates. The current expectation in the market, it's almost 100% probability that they will lower by 0.5% in September. Of course, that might change between now and then. And I still say there's a chance that we might get an emergency cut if those stock markets don't hold up. If the stock markets start collapsing, if we continue to have bad job numbers as we had in July, the last reported figure, I think it was July numbers, they were quite bad. If those numbers come through not so good in the coming days or weeks, then I think we might have an emergency cut. But the expectation is that we will get a cut in September of 0.5%, and there should be at least one, maybe two cuts before the end of the year. So gold is reacting to that because it reduces the carry cost of gold. If you've got a choice of holding a treasury bill or a gold bar, well, if the treasury bill's yielding 5%, you might say, well, buy the treasury bill and buy 5% more gold in 3 months or in 1 year. On the other hand, if the rates of treasury bills are going to drop, as is now expected, down to, they say, from 5.5% nearly to 5%, and then it will drop not 2 or 3 more times next year. I think the end rate, according to the forecast, is something like 3.75%. So that makes holding gold much more attractive, or rather holding treasury bills a lot less attractive. So that might be a factor which is playing into it. And the other factor, of course, which is playing into this is the absence of any willingness of the US government to address the debt problem. And we've all seen countless articles about how the debt is growing faster than ever. It's growing as a percentage of GDP. It's growing faster than the economy. The interest on that debt is increasing and increasing. I think it's something like 14, 15% of their tax take, and it's forecast to go to 25% of the tax take within a year or two. And within this decade, it could easily be 100% of the tax take. Basically, they'll be paying out 100% of what they take in tax revenues as interest payments if something's not done about this. So there's a growing worry that people will be paid back in depreciated dollars, in degraded dollars. So I think that's playing into the rise in gold, and international investors around the world are saying, well, I could own a little bit less dollars, a little bit more gold.
No, I completely agree. On the political side as well, I saw the Democratic candidate Kamala Harris, giving a speech, campaign speech, and she said she's gonna fight inflation. But she didn't say she was gonna fight inflation by cutting government spending, cutting the deficit, cutting the size of government. No, she said that she's gonna go after the price gougers, the big corporations, which is completely wrong because we know that inflation is created by excess government spending, deficit spending, central bank money printing. She didn't say she's going to go after the Fed, and candidate Trump hasn't said anything about cutting government. He said that he's going to honor all. Social Security entitlements. Not that I think that's wrong, but all these politicians, they don't go to the heart of the problem, which is government is spending too much. They seem to think that they can go like this, like Bewitched. I don't know if you're used to watch Bewitched, move her nose and
Yes, yes.
make everything better, make the economy grow so fast that the debt becomes worth a lot less per GDP. But uh, yeah, and I think that's probably one of the reasons why as well gold is holding up, Clive. And talking about gold, why don't we switch to silver? Because silver has had a pretty sharp correction, but I wanted to show you and the viewers this article I saw, um, and I saw it because someone posted it on X. Let me get it up here. And it's something you've been talking about, Clive, but it seems to be coming a little bit more mainstream, even though this is in the Jerusalem Post. But it says industrial demand might consume the entire silver market by 2025. Experts warn that surging industrial and military demand for silver could deplete inventories by 2025, driving price volatility and supply chain strains. And it goes over what the stuff you've talked about, Clive, technological advances, photovoltaics, solar power surge, EVs, military use, defense technology, aerospace, declining mining, and few new discoveries. And this is from these guys here, Johannes Bernreuter, head of Bernreuter Research, and Michael Di Rienzo, executive director of the Silver Institute. So it kind of, yeah, you've been talking, you were speaking about this
So,
over a month ago, Clive.
so if you add into that the jewelry demand and the cutlery demand, if you like, the utensils demand, we're actually in a situation where for the last 2 years and for the years which follow, the consumption is exceeding the supply. The difference is being made up by recycling. So people are bringing back or taking money out of the ETFs or withdrawing taking their their silver knives and forks down to the pawn shops to be melted down. But we're already in a situation of deficit where the industrial demand plus utensils and things like that is exceeding the supply. But of course, what we've got is a very large increase in the photovoltaic industry because more and more things that we use today contain photovoltaic cells, and those photovoltaic cells work best with silver in them. So I think we're very much in a. I think last year they said the consumption of silver for photovoltaic use increased by something like 47%, and for electrical use by 20%. So that just kind of shows you the rapid increase in that part of the industrial demand. Whilst they're not forecasting such a big increase for the current year, this is the Silver Institute, it's clear that the use of silver in electronics and in photovoltaic use is increasing. And I think that will create an ever-growing shortage of silver relative to the mine production. We've seen falling mining production now for a decade. It's below where it was a decade ago. I don't think that's likely to turn around anytime soon. And to force out those recyclers, you need to have a higher silver price to force people to go down to the silver or gold shop or the pawn shop and sell their candlesticks.
Yeah, and aside also from this jewelry demand that you talked about, there's also investment demand, I would say. But anyway, and some people in the silver space might be a bit discouraged. I'm not, because I've got both silver and gold, and I think silver is gonna do, and I've been saying this for years. I guess silver will eventually outperform gold. But we've got here Grady. He's a technical analyst from Sweden. He's quite popular. He's on X. He's got 71,000 followers. This is how he sees the current move in silver. We had a breakout here, and the market took off to like 32.50. And he's saying this is just a normal back test of the breakout, but it still remains quite bullish. And I think he's got another chart here about comparing gold and silver. And the last time gold and silver were so divergent as this, was back here in '09. And you can see that silver caught up, and gold didn't stop. It kept going too. So if we see silver catch up here, gold will also be going crazy. So that's what I'm trying to tell people. Um, of course, I look mostly at gold and silver as an insurance, not just against currency debasement, but the craziness of the world. But yeah, if you look at it more as a trade or investment, uh, yeah, that's a different story. And yeah, so
I mean, I think we should just warn the users that neither you nor I know what the silver price will do, but we do know what the currencies will do. They will debase, they'll become
yeah,
worth less. And the probability is when a currency is debasing, and if it debases faster, people run faster to look for things which are hedges against that debasement. And that's why I think that we're in a phase where trust in currencies is starting to erode. I think we're at very, very early stages. There's still a lot of confidence in the dollar, a lot of confidence in other currencies. You don't go down to the shops and people say, "Oh, you're offering me euros or dollars or pounds. Have you got something else?" That's not happening yet. But there are countries. When we were in Turkey on holiday earlier this year, everybody was far happier to take euros
yeah.
than Turkish lira. I mean, legally they would take the Turkish lira, but the prices were all displayed in euros because that's what they expected you to pay in. We're not in that situation yet for the major currencies, but we are in a situation where that level of confidence is not as high as it used to be. And I think that erosion of confidence will continue due to the ongoing deficit spending by governments. And as that continues, people will be hunting more and more for hedges against the debasement of the currency. And that's why I think gold and silver will be the obvious place to go. Um, Clearly, that does translate to higher price, but we're not really predicting a higher price here. That this is because there's lots of things which can change that. If they put up the interest rates a lot, if we have a serious recession, those sort of things will bring out the sellers of gold and silver because people won't have any money. If their interest rates are much higher, they won't be able to pay their mortgages. If we have a recession, they won't be able to have a job, and they'll have to sell things to eat. And of course, that would mean gold and silver lower. So it's not a one-way trip. But I think overall, the direction of travel will be higher because of the debasement of the currencies that we're in, and that bit will be accelerating.
It's interesting you said talked about Turkey. I was there last October. I went with my nephew and one of his friends for a golf holiday. And before I went, I bought loads of Turkish lira from the Bureau de Change. And like you said, they were kind of when you paid in Turkish lira, they looked at you like, where are your euros? So I learned it. But
Yeah, we did that. We bought 200 francs worth of lira,
yeah,
and where we went to pay, we took the taxi. When we went to pay the taxi driver, he was telling us the price in euros. I said, "Well, can we do
yeah,
that in lira?" And he
yeah,
gave us a price in lira, and I did the maths. It
yeah.
was roughly correct, so I got rid of some of the lira. But
But yeah,
when we got back, we'd still got the rest of the lira. We couldn't spend them anywhere.
one point I wanted to make though, and you said that in a lot of countries they prefer the major currencies. But what happens when the major currencies go down the drain? Well, I think they will probably accept a silver shilling if you go to the shop. I think that's why it's important to have not just a constitutional or what people call junk silver from the UK, for example, and those are pre-1920 in the UK, but also in the US for my US viewers. And you can see here that Miles Franklin has got a special on junk silver, if you want to call it that, pre-1965. They've got specials also for 1 ounce silver. These, of course, the Eagles. I'm not sure that I would be spending it first. I would probably be spending these because people would recognize the quarters and the half dollars and the dimes. But anyway, if you are interested in uh, protecting your savings, and this is not advice, check out Miles Franklin, and you can call them on 1-800-822-8080 or email them info@milesfranklin.com, and you can mention Mario or Monaco64. So let's see what else we've got here. The carry trade, Clive, I wanted to ask you because I've seen some people posting on X that JP Morgan is saying now that 3/4 of the carry trade has been unwound. And my first thought on that statement was that how can JP Morgan know that? Because the carry trade is done worldwide by anyone who has access to a major bank. They can call a major bank, and it could be a hedge fund, it could be a pension fund, it could be a high net worth individual, it could be someone like you when you used to work for the private bank. You could call them and say, look, I want to sell yen 6 months forward and buy Swiss francs. And then with those Swiss francs, you'd be start buying assets that were high yielding to try to uh, get a return, and you're expecting the yen to remain weak. You're not paying much for financing. So my question to you, Clive, is it possible to know, like JP Morgan seems to know, how much of the carry trade has been unwound? Unless, of course, JP Morgan has access to every major bank's balance sheets or trading records in the world.
Well, everything I hear, I put through a plausibility test, and that doesn't pass my plausibility test. Um, uh, when you're in trouble, if you're a bank which is in trouble, uh, there's three. As I said, I think there's this wasn't a margin call. They said there's three things you can do. One, you can lie and cheat about it. Two, you can try and get out of your trouble slowly without anybody noticing. Or three, you could be first. And being first means you say, to hell with the loss we're going to make. We know we're not going to get as good a price as we might get if we hang on there, but we're going to sell everything by, and in the trading view, they said, we want to be 75% out of these mortgage-backed securities by 10 a.m. and 100% out by midday. And then obviously the Fed's going to come in and tell us to stop doing it, but it'll be too late, we'll have done it. Was kind of how it played out there. So you may remember the first announcement about the carry trade came from, I think it was called, I forget the name of the bank, was it Norinchukin Bank in Japan? And they said they were going to unwind $60-70 billion of bond trades, which was basically saying they're unwinding the carry trade. They didn't use the word carry trade. They said they were going to sell foreign bonds. But between you and me, that means unwinding the carry trade. And they said that they would do it over the coming year. So in their view, at that time, it was going to take a long time over the coming year to unwind that trade. I can't believe that they and everybody else has miraculously unwound that curry trade, because that would have had a major effect on the market. Obviously, there was quite a bit of panic going on Monday and Tuesday when the yen rose massively from 161 a week ago, 2 weeks ago, against the dollar to 141 at one point against the dollar. So clearly, there were a lot of people who were selling US Treasuries and repaying their yen borrowings, and that caused them to sell dollars and buy yen. And why were they buying? Why were they selling dollars and buying yen? Well, the interest rate on dollars had fallen because people are expecting the Fed to cut rates, at the same time as the Japanese central bank, the BOJ, had raised short-term rates. So it's costing them more to borrow money, whilst at the same time they were earning less on their deposits in dollars, making the trade that much less attractive and in some cases unattractive. So they were unwinding, selling their treasuries, selling their bills, selling their bonds in US dollars, change those dollars back into Japanese yen to pay off their loan, hence the rise in the Japanese yen. So there was some panic there, but I don't really believe it's three-quarters done. There'll still be many who are trying to do it in an orderly way. So I would suspect it's 10, 20, 25% done. I think there's a long way to go.
Yeah, so I'm gonna end today with an article I saw, and I'll show it to you, Clive. Um, and then I'm gonna ask you, Clive, a question, see if you answer it correctly, or not correctly, but see what your answer is. So it's from Reuters from yesterday, exclusive. First Russia-China barter trade may come this autumn, sources say. So I thought this was interesting because when you read the Austrian School of Economics and the regression theorem analysis of money, you go back in time and you look at, let's say, a hunter-gatherer society. People just hunt in packs or whatever, and they eat what they hunt. And then they settle down and they start farming and they start bartering. And then they realize that bartering is a little bit tricky sometimes because you don't have the same wants and needs as the person you're going to barter with. And then eventually you find a most marketable commodity or something that has the qualities of money, like it holds its value over time, it's easily portable, it's divisible, and then you start, and then it becomes money, and you can stop borrowing. So my question, Clive, to you, what do you think would be the next step after Russia and China start bartering?
I'm surprised that they're bartering. I mean, you've got to believe it's from Reuters, so it's a reputable source, so you've got to believe it. But I'm sure they must be pricing these two commodities in some common denominator. I suspect that's still dollars, no matter what they say. So there could be a bit of political in this this article, not from Reuters themselves, but from China positioning themselves to be a little bit more anti-dollar. I have to say, Mario, in this picture, I kind of feel sorry for that poor guy standing under those huge sacks of concrete. I hope I hope he's all
Yeah.
right.
So what do you think, I mean, would be the next step from bartering?
So, well, it's a long road, but the talk has been about forming some kind of BRICS currency, which would be backed by commodities.
There you go.
To actually have a BRICS currency, they need the Asian Development Bank or a central bank of sorts to have control of those commodities and to settle up the balances between the various nations. So that's a lot of infrastructure, a lot of work to be put in place. It's not like you could just sit down between two countries and say, hey, we're going to issue the currency tomorrow. It'll
Yeah.
take a long time to come out, but it's on its way. And I think we're still some years before the BRICS currency really does exist. And we'll hear about it gradually as they start to put the wheels in place and start to build the central bank, which will hold those commodities.
Yeah, and I agree with you. They're probably using dollar prices to calculate the bartering deals. But if you go back in time, the dollar was a weight of silver and the weight of gold. So I actually think eventually these barter deals of commodity between commodities, let's say raw materials, will be done on the weight. And I believe that yes, they know that the most marketable commodity is gold. So if you do a barter deal, and let's say China has more of A to sell to Russia, so and Russia only buys A minus a certain amount, and then China buys B, all of Russia's B. Uh, China's still going to be left with kind of a surplus, and that's when I think gold will come into the fore. So what I'm trying to say is that we're going back to the regression theorem, which is quite amazing in my opinion. And the Americans in the West have actually triggered this by basically shooting themselves in the foot and using the dollar and other Western currency as a weapon. But I'll end it there, Clive, and maybe you could tell the viewers where they can find you if they want to be in contact with you.
So if anyone has any questions, you can write to me on LinkedIn. That's the only place I publish, and that's the only place I answer questions. I get questions on everything, ranging from should I buy silver? And then, of course, my question would be, what sort of silver are you thinking of buying, or why would you be interested in it? Is it for long-term saving? Is it for emergencies? Is it to pass on to your grandchildren? Is it a short-term trading idea? And then we'll discuss it and find the solution. I've got people asking about whether they should rent their house out or sell it. So any financial question which I've been dealing with in my wealth management career, I give you advice. I won't call it advice, but I give you some discussion points. It's all for free, so feel free to contact me.
Great, Clive. Yeah, it was nice speaking with you again, and I wish you a very nice weekend.
Thanks, Mario. Have a nice weekend.